Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter again, see what people are talking about, go through a couple of threads. I think there's some good ones with copper in this one, talking about the 10 largest mines and how we'll go through it. Talking about the 10 largest mines in copper. So lots of financial commodity related information in this. I'm obviously going to interject my opinions. And if you guys need anything, definitely check out the website, finding-value.com, if you want to join the membership. And if you want to follow me, it's at finding_finance. So I posted on here, gold's broken out, might still pull back some more before hitting support. I support flag patterns. So it's a flag pattern, and you can see that we could pull back even to 1930 with this big flag pattern. So we got uranium here. The Sprott Uranium Trust looking like it might attack its downtrend line and then go for the big boy resistance line at 1815. URNM is waiting in position. URA is also ready to rip as well. So this is the Sprott Uranium Trust. We could break out of here and attack that 1815 trend line here. Looking at URNM, you can obviously see a very large consolidation pattern that is still occurring, and we haven't broken out yet. So we're still consolidating. The same can be said for URA on a longer time frame, just to give you guys a little bit different perspective than URNM. We hit a bottom here in 2020. Now we're coming back up, and we've consolidated on top of support for a good over a year now. It's been over a year. So that's looking good. We've got oil. Oil looks solid and could very well start moving here, move higher here. The gold to oil ratio is cheap at 27 and looks ready to head lower. Outperformance of oil in relationship to gold. So here's oil breaking its downtrend line to the upside. That doesn't mean that we just go straight higher. It just means that we could start working upwards. And then the gold to oil ratio is at 27. This here is an anomaly, guys. This is way an anomaly. An expensive ratio against gold is something below 10. So 10 is off this chart to the downside. We got all the way down to 6 point something, I think, was the low of the ratio last bull market. So generally speaking, 30 is like dirt cheap for oil to gold ratio. And it's dirt cheap for oil. Coming on down, it says, one of the biggest money decisions you'll ever make is who you decide to marry. That is actually a true statement. I know some people at work that will just say they didn't have a lot of options as a guy, and they chose some pretty bad options. Females that were into drugs, stealing money, all of those things. So yeah, it can totally wipe you clean. They can, if you choose poorly. Giovanni says, charts on U.S. petroleum inventories in millions of barrels. So look at this one, guys. This is commercial and SPR. Look how low this is for commercial and SPR in relationship to history. Now, this is so low and the prices are still low because they're not considering the Strategic Petroleum Reserve releases as inventory. They're considering it as supply, just an FYI. So distillate and kerosene jet fuel, you can see we're at the low end here. That's the black line is 2023 versus all the other years, going back to 2015. We are very low for gasoline. So we're low for total inventory. We're low for distillate, kerosene, jet fuel inventory. We're low for gasoline inventory. And our total inventories are incredibly low in relationship to history. So why are prices so low then, right? Well, some of it is considered, at least this is what they tell me, as supply, that the SPR releases are additional supply and they're not being counted in total inventories. But you can see that total inventories are at the lowest level which could be forever when you compare it to consumption. So it'd be our inventory to demand ratio. Coming on down, we got too many people spend money they haven't earned to buy things they don't want to impress people they don't like. Will Rogers. If that's you, stop wasting your money and start spending on what you value. I will say this, guys. I am 100% in this opposite camp. And I'm 100% in this camp here. So I do not spend money to impress anyone. I don't even really spend money to impress even myself, I guess. I spend money on things that I thoroughly enjoy, and that is it. I don't want to spend anything else on anything I don't thoroughly enjoy. I do not try to impress a single person. I can give two craps, and that includes probably people that are friends and people that I'm involved with. I really don't care about the impression that I give to other people in terms of clothing. But no, here's something. I'm gonna come back in here real quick. All right. I wear blank t-shirts, guys. Like, I do not want advertisement on my shirts unless it's something that I'm involved with. I generally don't buy name brand anything. Anything. I drive cars that basically people just said, here, take it. And then I go and I fix it. And then if it's a really good chassis, that's where I get really, that's where my fun is. It's finding the value out there. It's finding value. That is my entire life, is finding where the value is in my entire life. I do not spend if I don't have to. Now, there's things as you get older and you make a lot more money, like buying, going out to restaurants every once in a while. I don't really go out to restaurants, but I do eat out sometimes. Every once in a while, I do that, and I do eat at home a lot because I think it's a lot healthier, and that's what I prioritize. I prioritize health, I prioritize wealth, and I prioritize time. And time and wealth are interconnected. So when I look at something and I'm like, "Hey, should I buy this?" It's like, well, is the enjoyment from it going to outweigh how much money I'm going to spend on it? A lot of the times the answer is no, and I do not buy it. I do buy things more generously for my children, but for myself, I'm a pretty hard, I'm a pretty hard person to spend money for. And what you'll actually find is I do like cars. I do spend some money on cars, no doubt about it, and that's where I do spend a little bit of money. It's not a lot. I just find deals left and right, and I buy a couple extra sets, and then I have them for backups like brake pads, rotors, like when they go on deep discount, spark plugs, stuff like that. Just have extras. But in the grand scheme of things, I don't really spend that much money at all, hardly at all. I fix all my cars myself. I do everything kind of myself, and I just find deals. If something breaks, I replace it with not something that's cheap, but I replace it with something that I think will last a really long time. So I look for the value in it. I don't want to buy another cheap toilet handle made of plastic that just breaks, after 3 years, 4 years, 5 years. You buy the one that's all metal, and that'll last a long time, and that's generally what I get. And the price difference might be double in price, but it'll last hopefully forever. So that's what I do, and I really don't care what other people think. Like, in fact, I despise those people. Not despise them. I should say people who care about what if they're playing this game. The majority of the time, I'm not friends with them. I generally link up with like-minded individuals, people who are trying to build wealth, people who are frugal. They want to fix their own things. They prioritize ideas over materialistic, I don't know, whatever it is. And that's basically what I've surrounded myself with my entire life. So I look for people who are also trying to seek value in this world. They want to learn things. They want to debate topics, debate ideas, and that's kind of where I live. But yeah, just want to kind of tell you what I do. The shareholder report. So this is a great BHP chart in the tweet below showing how copper deposits are getting deeper and more costly. Over time, average copper grades have been decreasing and the depth of mineralization has been increasing. So lower ore grades, deeper mineralization. So this is a 3-dip target tonnage of 4 billion and mineralization starts at surface. So we've got a hat copper gold project 3D IP chargeability, and you can see the depth, vertical depth over 1250 meters in terms of this depth of whatever this deposit is that they've got, which is probably copper. So that's something to also keep in mind. And we've talked about declining ore grades and the increased energy cost, which is not linear. It's exponential when you get below a certain ore grade. Exponential energy inputs. Coming on down, we got U. Yeah, we talked about U.UN, Sprott trying to break out. Another one also seeing that. By year end, sold out signs at the gas stations as we're going real low on U.S. gasoline storage. We also went cover that earlier. This is Patrick. He says U.S. purchasing power momentum has carved out a massive top and is breaking down. Takeoff platforms for gold, silver, and crude oil are found in these areas. Massive top in momentum, heading on down. This is the U.S. purchasing power coming on down as well. We can also see, if you look at these tops in this momentum, it is also a signal for the bottom for silver, oil, and gold. Bottom, bottom, and bottom, and bottom. So we're putting in a bottom here. We could head higher in silver, oil, and gold. In my opinion, they all look very good in terms of their charts and breaking out of resistance levels. So gold, silver, and oil all look very good. Uranium is also looking excellent. So let's hope that we get this big move that comes up over time, and it's a big tailwind for us. Let's hope that all occurs and happens. So one of the best ways to learn about the copper industry is by studying the top 10 global producers. I read each of the top 10 copper producer quarterly reports, so you don't have to. Here's the thread on the most important data and themes from the world's largest players about copper. So Codelco, copper production is down 9% to this. Cash costs are up 33.7% to $2.04. The reason for product decline, operational difficulties, lower production and ore grades, and mine shutdowns. Reasons for high cash costs, higher input prices, diesel and electric. And I think this is going to be a theme. Remember what I said about mining companies in general. They're going to do well. I think some companies are going to do very well in the beginning when the initial shortage occurs. There's going to be a large movement up in the commodity price. And depending on what's driving it, it's going to be demand exceeding supply. At some point, though, that's going to be a shortage, not of the metal itself, but everything will convert to a shortage of energy. Because all of those things are a derivative of energy. And if you need to continually put into production an infinite amount more of any material that is to support a percent increase of growth, which is any percent increase of growth is a exponential function. That means that you need to put in an exponential amount more of energy input. And depending on where you are with your ore grades, and we just talked about declining ore grades and deeper mineralization, we are going to need to put in copious amounts more of energy at an exponential clip to increase our production of these low ore grades at deeper mineralization with larger and larger inputs of energy. And that's going to be a drag on energy. It's going to push energy prices higher. So then the question is, are these companies going to make more money as a mining company? I think some of them will that have really good deposits with high ore grades. They could make a killing. Other ones may or may not. So it'll be interesting to see how this all plays out. That's also why I'm a huge advocate of the physical metal itself, because in that type of scenario, in a low energy cost mining regime, you can buy the metals very cheap. But when energy becomes more expensive and the ore grades decline, that is an environment that's going to price the metals much higher than where they are today. At least that's my opinion. So here's Freeport McMoran, that's FCX. Copper production's down 4.3%. Cash costs up 33% to $1.76 a pound. Lower ore grades, unplanned maintenance, and weather. And then the reasons: lower volumes, higher labor, and energy costs. Come on down. Here's Glencore. Copper production down 5% and down 15% from prior quarter. Reasons for production declines: lower grades with phasing out of the Colossi pit, weather delays in Antamina. BHP, copper production down 4% to here and up 12% year over year, year to date. Escondida production's up 11% to that. Olympic Dam production's up 88% to that. Commentary on copper production: lower volumes at Escondida reflect the impact of diff ore feed sources and refined capacity. Southern Copper production's up 4% year over year to that, but down 7% from the prior quarter. Cash costs are up 31% year over year to 76 cents a pound, and up 70% from the prior quarter. Reasons for production decline: lower grades and temp production suspensions. Reasons for high cash costs: low volumes. Antofagasta, copper production's up 5.1%, but down 25% from prior quarter. Cash costs are up 6.4% to $2.49 a pound, and up 24.5% from prior quarter. Reasons for it: reduction at Los Palambros, water issues. Reasons for high cash costs: inputs and production. First Quantum, copper production down 24% year over year to there, and down 33% from prior quarter. Cash costs are up 39% year over year to $2.24 a pound, and up 20% from prior quarter. Reasons for production decline: suspensions, lower grades, and rain. And what's the reason for the cash cost increase? Volumes and input prices. KGHM Polska, copper production down 3%, cash costs up 5% to $2.39 a pound. Lower ore grades and recovery rates, lower volumes, higher input prices, energy and labor. That's the reason. Anglo American, copper production's up 28%. Cash costs are $1.56 a pound, unchanged from prior guidance. Reasons for production increase: ramp up of a mine in Peru, offset by Chilean mine declines due to lower ore grades. And then Jinja Copper, copper production's up 3.2%, operating costs up about 10%. Higher volumes, fewer suspensions. Reasons for higher costs: increase in raw material costs. So there you go. Recap. Key takeaway from the top 10 copper producers: there are few key takeaways. Cost inflation is real and isn't showing signs of a slowdown. Lower ore grades increase costs and pressure margins. Diseconomies of scale at lower volumes. The conclusion here is, I hope you enjoyed this thread and learned something new. Check out my podcast to learn about the commodity super cycle. I agree, we are in a super cycle. Here's EU natural gas inventories in percent of full. This is EU at 64%, Germany at 70%, Italy at 70%, France at 46%, Netherlands at 64%, Spain at 92%. But there we are right now, where we are in 2023. And it's going to come on up during the summer months. And you can see that we didn't really decline like we did as much, that the rate of decline was very shallow. This we'll call it the rise over run isn't as steep. This isn't as steep as this, and it didn't go as far down. And that's why prices of natural gas are so cheap. Oh. So coming back down, since I accidentally hit that, there's the copper thread. It says, call me crazy, but this chart from Dietz Akan on new construction actually looks perhaps healthy. Yes, we have lots of shelter in construction, but we need it, and growth is not exponential or bubbly. What if record construction turned out to be good for America? This is housing units under construction, multifamily versus single family. You can see that we had a pretty big run up here, but we're still at a very high level. This is housing units, and it just keeps building, building, building. We're still at a very high level. We are building more multifamily versus single family. You can see single family has cooled off some, probably because of affordability, and we're building a lot more multifamily. Here's North Star. It says gold. Remember this. It subsequently broke out and gold moved up $400. A drop of 100 plus should follow to test the breakout. Then it gets much more interesting. So this is a breakout gold bull market Boren, a breakout gold market Boren, and no gold bull market unless until this breaks out. And I don't know if this is, yeah, it looks like September 18th, 2022. We have broken out of this. So it's going to get a lot more interesting, guys. We've got, is everybody bearish inflation now? Crude oil is telling me much more inflation is yet to come. So we've broken out of this paradigm shift, the breakout line up here. We've broken out and we're doing a retest, and then I think we're going to run up again. This here is, I think it's momentum that he's charting down on the bottom here. And you can see these big momentum moves to the upside here after a consolidation period. So we moved higher, consolidated, and then had a blow off top. We moved higher, consolidated, had a big move after that. We had a move higher, broke out of that resistance line. So there's your resistance line and the consolidation, resistance line consolidation, resistance line consolidation. And we're probably going to have a big, great explosion. Just like he is talking about. It looks very good for crude oil and that explosion to happen at some point in the future. Here's another one by Paul Harris. He says, great chart by Mike Henry, BHP, at B of A conference on challenge of developing new copper projects. Fewer projects and deeper equals a lot more money. This is the depth to mineralization. And this is what we've been producing here recently. And in 2020 here, you can see 2020 onward, there isn't really anything coming on, and we start to move lower and lower. So that's your depth of mineralization. We are going after deeper and deeper with lower and lower ore grades, which costs a lot more money. This is what's going to drive the cost curves of a lot of these materials a lot higher. The physical metals are the surest way to play this because the mining companies are going to have to mine this somehow out of the ground. This move lower, as you see the depth to mineralization and also the lower ore grades, is a function of exponential energy input increases. And that may or may not impact the profitability of a lot of these mining companies, depending on what they own and the projects they have in their stable, so to speak. The physical metals, if you're buying all the metal back here and you're loading up, let's say in 2000 when it's still cheap, what you're doing is you're taking low energy, you're taking higher ore grades, you're basically stockpiling it at that time, and then you're going to sell it in a completely different environment out here where there's just massive scarcity. The commodity bull market is coming, guys. It's just a matter of time. It just depends how patient you are. But that's what I've got for today, guys. That's as far as I'm going to go today. If you guys like the content, give me a thumbs up. Subscribe to the channel if you haven't already. And we've got a platinum question and answer session at 5 p.m. Sunday. We'll see you there if you're a platinum member. We can talk about the opportunities and how to take advantage of this. I think we are. If you're a member, you already know basically, I think, what my opinions are on it. I'll just put it that way. But we'll cover some companies. Oil's looking a lot better, and I've got my favorites, and we'll talk about that. So that's what we've got, guys. We'll catch you next time. This is Finding Value.